Hello class, we are beginning chapter 13 today. So chapter 13 is a continuation of chapter 11, which is about capital budgeting. So we continue to add more items to our project, things like opportunity costs. So like in the Indian River case, the opportunity cost would be if part of the plant was going to be leased to someone else and now they're going to use it, the lost lease revenue would be an expense in the operating statement. But we are going to review today the calculation of coefficient of variation. So the coefficient of variation basically tells a company what the level of risk is. So what does that mean in words? So if you think about standard deviation, that's the difference of all numbers to the average. But the coefficient of variation tells you what is the context. So for example, if we were looking at house prices within a certain zip code, and the house prices varied, let's say $20,000. That might be your standard deviation. But in another zip code, they might vary by $500,000. Let's just say someplace on the coast of California. So seeing that standard deviation, $20,000 versus $1 million, is not that meaningful. That's why the coefficient of variation is, because it tells you what is the variation within that population. So it's very meaningful, and we look at this to calculate standalone risk, which is the only type of risk we will calculate. So what we need to do is set up our base calculation. So you'll do it for the mini case, which is not for homework. You can practice with that too. For homework on Thursday will be to do the Indian River case 2. And you will calculate first the base case. Now the base case will have the base amount of units sales and the base amount of salvage value. You're going to then copy that whole spreadsheet, but make a best case, and you're going to change two variables. You're going to change the unit sales and the salvage value, and you're going to calculate the net present value. And lastly, you're going to do the same thing one more time and change the unit sales and the salvage value and come up with the worst case. So you're going to have 3 numbers here, and I recommend setting this up and everything is referring to a cell. So that net present value number that you have here, you're going to refer to wherever that is in your spreadsheet, whatever tab it's in. So I said first you're going to change the variables. That's step 1. Step 2, we're going to use a new formula within Excel, standard deviation. You're going to calculate the standard deviation of these 3 amounts, the net present values. And we're going to leave that for the moment. Item 3, now you're going to calculate the weights of these 3 possible scenarios. And this is, again, the scenario analysis. So you're going to calculate the net present value times a probability that that will be achieved and come up with a new amount. The base case times 50% and come up with that amount. And the worst case, 25%. And you're going to add that up, and that's going to give you the weighted average of the net present values. And lastly, you are going to divide that amount by the standard deviation and use another and last calculation called the coefficient of variation, and that's the CV calculation. So what that's going to tell you is a number like 1.3 or 2.0. And the question is, at the end of the day, the reason we're doing this is to figure out how risky is this investment? At what level of risk does this company like to operate? If they don't want any projects that have a coefficient of variation of, say, over 1.5, and you calculate this as 2.0, in other words, there's too much variation between the best sales and the worst sales, because they affect it much more so than the salvage value, then it's just a project that does not should not be implemented. So that is, at the end of the day, after we do all these calculations, what we would then recommend that a company either take the project or not. So your homework for Thursday will be to take these calculations and implement them with the Indian River case. So I hope you all have a great day, and I will see you all soon.